Moving average. Moving average is a famous technical indicator used for analyzing the financial markets. The price of a financial instrument continuously moves up and down. The traders analyze this price fluctuation to predict the future price movement. However, the rapid price change also increases the possibility of a false signal to the traders. The moving average indicator comes in really handy in this scenario. It filters out the noise and provides an insight to the price changes. Moving average indicator does that by calculating the average price over a specific period of time. It can be any period the trader chooses. Calculation for a simple moving average is done by adding up all the data points during a specific period and dividing the sum by the number of time periods. The reason it is called a moving average is because the average is constantly recalculated based on the latest price data. In technical analysis, there are several advantages of using a moving average. The first and foremost advantage is that it simply filters out the noise created by random price fluctuations. This helps traders to analyze the price movement from a different perspective and make better decisions. Another advantage is that it can be used on any time frame, meaning it is equally useful for long-term and short-term traders. It indicates the potential support and resistance areas, and also informs the traders about the trend direction. With all these advantages, there are several trading strategies that can be adopted using just the moving average indicator. The moving average is not only a useful enough indicator on its own, but it also forms the basis of other technical indicators, such as MACD. So, understanding and learning the moving average indicator will also help you to use several other technical indicators. It's also worth knowing that the moving average is a lagging indicator and is based on past prices. Therefore, it does not provide an advance indication and only confirms a signal after a price shift. Types of moving averages. There are mainly three types of moving averages: the simple moving average, weighted moving average, and exponential moving average. The difference between these moving averages is the sensitivity they show to the price fluctuations. The simple moving average gives equal weight to the entire price range in a particular period, while the weighted and exponential moving averages give more weight to the recent price action. This makes them more sensitive to the recent price action, and it produces more signals compared to the simple moving average. How to use moving average indicator. Fortunately, the moving average indicator is available on all modern trading platforms. It's extremely easy to plot a moving average on a chart. A trader only needs to select a period, and the trading platform does the rest by constantly calculating the average based on the latest price. So, when a moving average is plotted, you will see most of the price action takes above and below the moving average line. The simplest way to get an idea about the trend using the moving average is by looking at the current price and the moving average line. If the price stays above the moving average line, you can say the price is in an upwards direction. Conversely, if the price stays below the moving average line, you can say the price is in a downwards direction. This is just the simplest method of looking at the trend direction. However, it's worth knowing that the moving average tells you only about the general direction of the trend. For a deeper understanding of the trend, you will also require other technical indicators. Other than knowing the general direction of the trend, you can also use the moving average line as a support or resistance area. As a general rule of thumb, when the moving average line remains below the current price, it acts as a support line. So, whenever the price comes down to the moving average line, the price may bounce back. It basically tells that there is enough demand around that area. Likewise, when the moving average line remains above the current price, it acts as a resistance line. So most of the time, when the price goes up to the moving average line, it drops lower, meaning the market is well supplied at the point. Remember that the moving average support and resistance areas are dynamic, meaning they change with the price movement and do not remain static like the trendline support and resistance areas. You can also use the moving average line to identify the breakouts. One of the simplest ways to do so is by looking at the current price when it closes above or below the moving average line. For instance, you can call it a bullish breakout when the price of an instrument finally closes above the moving average line after several previously failed attempts. Such a breakout indicates a bullish momentum, and traders prefer taking long trades in this scenario. Likewise, you can call it a bearish breakout when the price of an instrument finally closes below the moving average line. Such a breakout indicates a bearish momentum, and traders generally place sell trades in this scenario. Moving average time frame. To analyze the market using the moving average, you have to decide on a time frame. The time frame largely depends on your trading approach. For example, if you are a long-term trader, you need to select a longer time frame, and if you are a short-term trader, then a smaller time frame may also work for you. Remember, a bigger time frame gives you a better sense of the market. Even if you are a short-term trader, it's always a good idea to start on a bigger time frame and then scale it down. This will help you understand the overall picture of the market. Other than the time frame, you also have to decide on the type of moving average to use. For short-term traders, exponential moving average generally works well because it emphasizes more on the recent price action. For long-term traders, the simple moving average is a better choice, as it clears out the sudden price fluctuations in a better way.